So you've done the responsible thing, right? You're disciplined, you've built up that safety net, and you're consistently funneling money into savings every single month. And honestly, it feels incredibly great, until you hit a wall. Welcome to This Explainer. Today, we're unpacking a massive psychological hurdle that trips up even the most disciplined savers out there, making that emotional leap from just hoarding cash to becoming a confident long-term investor. We're going to map out exactly how you can make this vital mindset shift without, completely risking your sense of financial security. Because here's the painful mathematical reality of the situation. Let's say you hit a huge milestone. You've got $10,000 sitting right there in your savings account. But at a 0.5% yield, a whole year of diligently guarding that money earns you a grand total of $50. Yeah. It's usually right at this moment you realize that while saving is an absolutely essential defensive habit, playing defense alone rarely builds actual wealth. You kind of start wondering, wait, am I doing this wrong? Especially when it seems like everyone else is out there compounding their capital. And really, that friction you're feeling, it comes from confusing two totally different financial jobs. Look at it this way. Savings are designed to protect your money. Investments are designed to grow your money. Forcing a savings account to generate wealth for you is literally like using a shield as a sword. You're just using the completely wrong tool for the job. To fix this, you have to shift your mindset. You need to recognize that a specific part of your money needs to be purposefully deployed for growth, rather than just kept safely sheltered from harm. When you actually look at the math behind that mindset shift, it is staggering. Think about a 20-year timeline. If you leave that same $10,000 in a typical savings account, you might net yourself an extra $2,000. Okay, not nothing, but compare that to deploying that same capital into the S&P 500. Historically, that averages around 10% annually, which pushes your number towards $67,000. Same exact starting capital, but we're talking about a completely different universe of outcomes. The ultimate wealth gap isn't usually between savers and spenders, it's actually between savers and investors. So, if the math is so obvious, why is taking that leap notoriously hard? Well, because it's not a math problem at all. It's entirely a psychology problem. Your immediate reaction is probably something like, okay, but I really don't want to lose my hard-earned safety net. And honestly, that is a completely rational fear. Savings sit perfectly still, which feels safe. Investments, on the other hand, swing wildly. They go up, they drop suddenly on a random Tuesday, and that emotional volatility is the ultimate barrier that keeps smart, disciplined people sitting completely on the sidelines. To conquer that fear, you actually don't need a higher risk tolerance. You just need a mental firewall. You've got to start treating your finances as two totally isolated buckets. Bucket one, that's your safety money. It does not move. But bucket two is your growth money. And here is the absolutely crucial behavioral shift you need to make. Bucket two is expressly allowed to fluctuate. Its specific job is to ride out those ups and downs so it can capture those long-term gains. By mentally splitting your capital into these two distinct categories, you aren't gambling your safety net. You are simply putting a separate, dedicated batch of money to work. This psychological firewall actually translates into a really practical 5-step framework for entering the market safely. Step one is your absolute non-negotiable bedrock. Build a real emergency fund in cash. Why? Because the biggest reason people panic sell their investments is that they suddenly need immediate cash for, say, a job loss or a medical emergency. Your emergency fund literally protects your investments from your own life. Once you have that locked in, step two is mentally separating those buckets like we just talked about. Step three is starting small, just to build up that emotional muscle. Step four is keeping it simple, and step five, just stay disciplined. Let's actually double-click on step four for a second, keeping it simple. The biggest behavioral trap for beginners is assuming that investing requires high-stress day trading or, crazy crypto speculation. I promise you, it absolutely doesn't. Simple tools like index funds completely remove the emotional stress of trying to pick a winning stock. They do this by letting you own a tiny slice of the entire market all at once. You get instant diversification and steady long-term growth. It's pretty much the ultimate set-it-and-forget-it tool, eliminating the need to micromanage your portfolio. In fact, that's exactly why legends like Warren Buffett champion them for the vast majority of investors. To put the power of this into perspective, imagine investing just $300 a month at an 8% average return. Fast forward 25 years, and notice the final tally, nearly $285,000. But wait, here is the most important number in all of this, the pure growth. Out of that massive total, you only contributed $90,000 out of your own pocket. That means nearly $200,000 of that total is just compounding, working its magic in your favor. That right there is the unbelievable leverage of consistent, unemotional investing over a few decades. But letting that compounding happen means sitting through some really uncomfortable moments. Think of it this way. Saving money is kind of like storing seeds in a glass jar. You can see them, you are protecting them perfectly, but absolutely nothing is ever going to grow in there. Investing is like taking those seeds and finally planting them in the dirt. At first, it looks messy, you don't see results immediately, and there are storms and bad weather along the way. But over time, things grow. Eventually, you get a harvest far bigger than the original seeds you started with. You just have to be okay getting a little dirt on your hands. Now, I know what you're thinking. What about the inevitable storms? What if a massive market crash hits? Well, here is the ultimate mindset shift you need. Experienced investors do not view crashes as disasters. They view them as aggressive discounts. Look, market downturns are completely normal historical events. When the market drops, your consistent monthly investments automatically buy more shares at clearance prices. And that leads to dramatically stronger returns when the market inevitably recovers. You literally stop dreading volatility when you realize a crash is basically just a temporary sale. Ultimately, it all comes down to what you want your money to actually achieve for you. Saving gives you stability. It's that peace of mind that a flat tire or a broken boiler isn't going to totally ruin your month. It is the necessary foundation. But investing gives you freedom. It provides the compounding leverage required to eventually buy back your own time. The earlier you can overcome that psychological fear of volatility and deploy both of these strategies together, the more incredibly powerful your financial future becomes. So, as we wrap up this explainer, I want you to take a hard look at your own financial psychology. Are you currently in the saving stage, still staring at those seeds in the glass jar, paralyzed by the fear of losing them? Or have you already embraced the dirt and started planting? Remember, moving to the next stage isn't about abandoning caution at all. It's about deploying your capital with real purpose. Take that